stop. Don't you dare scroll past this. I know you're busy. I know you've seen 100 Bitcoin videos this week, but what I'm about to tell you in the next 60 seconds is something that the biggest crypto channels on YouTube are completely sleeping on. And if you miss this, if you tap out early, you will be kicking yourself in the next few weeks when this plays out exactly the way I'm about to describe. So stay with me, because this one is different. Michael Saylor stopped buying Bitcoin. Let that sink in for a second. The man who turned his entire company into a Bitcoin buying machine. The man who went on every podcast, every interview, every stage and said the same thing over and over again. Buy Bitcoin, stack Bitcoin, never stop buying Bitcoin. That man this week did not buy a single coin. And the moment that news broke, the entire crypto market froze. People started asking the question nobody wants to say out loud. Is this the top? Is it finally over? Or is Saylor seeing something coming that the rest of us are completely blind to? I'm going to break all of it down for you right now. The data, the real story behind the pause, the institutional moves happening in the background, the regulatory bomb that could detonate at any moment, and exactly what levels you need to watch in the coming days. No fluff, no hype, just the raw picture. Let's go. First, let me paint the full scene for you because context is everything. Bitcoin is currently hovering in a zone that traders call no man's land. Not in euphoria, not in full panic. Right in that uncomfortable middle ground where the market is making a decision. Market cap is sitting around $1.5 trillion. Volume is solid, showing real participation. Exchange reserves of Bitcoin continue to fall, meaning people are pulling their coins off exchanges and moving them into cold storage. That is a textbook supply squeeze signal. Fewer coins available for sale. And historically, when supply tightens like this and demand shows up, there is only one direction: price moves. Now, Bitcoin has been in a rising channel that started from the lows we saw earlier this year when price crashed hard. We are approaching the upper end of that channel right now. Resistance is sitting near the 79,000 level, and then that massive psychological 80,000 wall that has been rejecting price every single time. Support is holding around the 70 cents value 500 to 78,000 zone. The 200-day moving average is up near 82,000. So the picture is simple. Break above 80K with conviction and momentum, traders pile in and we go. Lose 7,500 with volume and we flush toward 75,000 and potentially lower. That is the battlefield. That is where everything is being decided right now. And right in the middle of all this tension, Saylor goes quiet. Let me give you the full picture of who this man is and why his silence is so loud. Michael Saylor's company Strategy holds over 818,000 Bitcoin. Over 800,000 coins. Their average purchase price across all those coins is around $75,500 per Bitcoin. So yes, they are still sitting on a gain right now, but the margin is not comfortable. Every dip toward that level puts them closer and closer to their average cost. And here's where it gets even more interesting. Strategy is reporting their Q1 earnings on May 5th. That earnings report is going to cover Bitcoin's worst quarter in recent memory, when price was stuck below 75,000 for weeks and crashed all the way down to 62,000 in February. Analysts are saying that report will show over $14 billion in unrealized losses. 14 billion, and Saylor paused his buying right before that report drops. You think that's a coincidence? Maybe. But in this market, nothing is ever really a coincidence. Now, I want to lay out both sides of this debate because the market right now is split completely down the middle and both arguments have real weight. The bearish case is straightforward and honestly a little scary. The man who never stopped, stopped. That is the entire argument in one sentence. When the most vocal, most aggressive, most conviction-driven buyer in the entire space takes a step back, it sends a signal. The bears are saying Saylor saw something. Maybe he sees distribution happening at these levels. Maybe internally their financial models are telling them that 78,000 after the recent recovery is stretched. Maybe the Q1 earnings pressure is real and they need to manage optics. Whatever the reason, when the king goes quiet, the bears take notice. They are pointing to past cycles where major accumulators paused right before significant corrections. They are saying this is the classic pattern. Smart money slows down, retail gets comfortable thinking the coast is clear, and then the rug gets pulled. But here is the bullish counter argument, and honestly, this one might be even more powerful. Saylor paused, and Bitcoin held. There was no massive sell-off, no panic, no cascade of liquidations. Price stayed right where it was. And that tells you something enormous. It tells you that demand is coming from somewhere else. If the biggest single corporate buyer steps back for a week and the price does not fall apart, it means the market has other buyers, real buyers, institutional buyers. And if Saylor comes back next week or the week after with a massive purchase funded by new convertible bonds, which he has done multiple times before, then this pause is not a top signal at all. This pause is the calm before Saylor goes even bigger. That would be one of the most bullish developments possible. Supply gets tighter, his buying resumes at scale, and price has no choice but to move. I cannot tell you with certainty which of these scenarios plays out. Nobody can. But I can tell you which data points to watch, and I can give you the full picture so you are not flying blind. Let's talk about the institutional side, because this story is being massively underreported. In April, spot Bitcoin ETFs pulled in roughly $1.9 billion in net inflows. 1.9 billion. BlackRock was buying. Fidelity was buying. The kind of institutions that manage pension funds, university endowments, sovereign wealth, those people were quietly accumulating while retail investors were confused and sitting on the sidelines waiting for certainty. These are not emotional buyers. These are not people who see a green candle and FOMO in. These are people who run sophisticated models, who have internal compliance teams, who have investment committees, and who only deploy capital when they have real conviction. And they had conviction throughout April. Now in May, that trend is continuing. ETF flows turned positive again after a few negative days. The direction is shifting back toward inflows. And here is why that matters so much. When institutional capital flows through regulated ETF vehicles, it is not speculative. It is structural. It is long-term. It does not panic sell on a bad tweet. It does not get shaken out by a week of red candles. This kind of money acts as a floor under the market, and that floor is being built right now, whether the retail crowd realizes it or not. There is something else happening right now that almost nobody in the crypto space is talking about loudly enough. The US Senate's Clarity Act recently cleared a major procedural hurdle. Stablecoin legislation is moving forward. The White House crypto advisor literally posted "Go time" publicly. Do you understand what regulatory clarity means for Bitcoin? Right now, there are trillions of dollars sitting on the sidelines. Institutional money that wants exposure to Bitcoin but cannot justify it internally without a clear legal framework. The moment the US government provides that framework, and it looks closer than ever before, that money does not trickle in. It floods in. We are talking about a potential wave of capital that makes everything we have seen so far look like a warm-up. And I want to keep giving you real context here because dates matter. May 15th is a date you need to mark in your calendar right now. Jerome Powell's tenure as Fed chair ends on that date. Kevin Warsh, who Trump selected as the replacement, is coming in. Warsh has historically been associated with tighter monetary policy. A new Fed chair means new uncertainty. New uncertainty means volatility. Bitcoin and crypto broadly are extremely sensitive to shifts in monetary policy expectations. The market is already dealing with the fact that the Fed held rates steady recently and gave zero signals of imminent cuts. If Warsh comes in and markets start pricing in a more hawkish stance, risk assets, including Bitcoin, could face pressure in the short to medium term. This is not a reason to panic. It is a reason to be aware and to have your risk management in place. Now, let me give you the supply picture because this is the foundational argument that never goes away, no matter what happens short term. There are roughly 20 million Bitcoin in circulation right now, out of a maximum supply of 21 million. That is it. That is the cap. No government can print more. No central bank can dilute it. No emergency meeting can change that number. As more long-term holders take their coins off exchanges and into cold wallets, the available liquid supply shrinks further. We are already seeing exchange reserves at notable lows. Combine that with ETF buying, combine that with corporate treasury accumulation, combine that with growing nation-state interest, and what you get is a structural supply shock that plays out over months and years, not days and weeks. The big price target people are throwing around still stands. Arthur Hayes, who called multiple major moves correctly, is targeting 145,000 Bitcoin by end of 2026. Franklin Templeton, one of the largest asset managers in the world, has 100,000 plus as their base case. These are not anonymous Twitter accounts. These are serious institutions and serious analysts putting their names and reputations behind these numbers. That does not mean it happens in a straight line. There will be painful corrections. There always are. But the direction they are pointing is clear. Let me now give you the exact technical levels that matter, because if you are going to act on any of this, you need to know where the critical points are. On the upside, a daily close above 79,200 would be a very strong short-term bullish signal. It would mean price has flipped the recent resistance into support and momentum traders would start entering aggressively. Above that, 80,000 is the big psychological level. A convincing break and hold above 80K opens the door toward the 82,000 zone where the 200-day moving average lies. Breaking above the 200-day EMA with volume would be a massive technical event that would attract a completely new wave of buyers who use that indicator as their primary signal. On the downside, 77,800 is the first line of defense. If that breaks on meaningful volume, 75,000 becomes the next major test. 75,000 held during April's pullbacks, and it is widely watched as a critical support. Below that, 73,500 lines up with the 50-day moving average. If 73,500 gives way, the conversation shifts quickly towards 70,000, and nobody wants to talk about what happens below that level. But here is the thing. For that deeply bearish scenario to play out, multiple things would have to go wrong at the same time. ETF flows would have to reverse hard. The geopolitical situation with US-Iran tensions and oil prices would have to escalate dramatically. And institutional accumulation would have to stop. None of that is happening right now. There is also something subtle happening in the altcoin market that confirms Bitcoin's dominance in this cycle. Ethereum is sitting around the low 2000s. Solana is in the low 80s. Altcoins broadly are not running. Bitcoin dominance is holding firm. This tells you that the smart money, the institutional money, is choosing Bitcoin specifically, not the broader crypto market, not the altcoin casino. Bitcoin, the pristine collateral, the digital gold narrative, the fixed supply asset. That is where conviction is concentrated right now, and that is a structural positive for Bitcoin. Let me bring up one more thing that is almost too obvious to mention, but somehow still flies under the radar. Bitcoin Pizza Day is on May 22nd. Now, before you roll your eyes, hear me out. Every year around this date, the broader media picks up Bitcoin stories. Casual investors who haven't thought about crypto in months suddenly see articles, suddenly see price discussions, suddenly get curious. In a market that is already at a sensitive inflection point, increased attention can absolutely act as a catalyst. Small things matter in consolidating markets. Sentiment shifts happen fast. Here is where I am personally landing on all of this, and I am going to be completely straight with you. The Saylor pause is unusual. It deserves attention. It is not something to dismiss. But 1 week of no buying from a company that owns over 800,000 coins is not a top signal on its own. Not when ETFs are still accumulating. Not when Senate legislation is moving. Not when supply is tightening. Not when long-term holders are not selling. The structural bull case has not changed. The macro tailwinds have not reversed. What we have right now is a moment of elevated uncertainty layered on top of a fundamentally strong longer-term picture. The dangerous move right now is to make emotional decisions based on one headline. The dangerous move is to see Saylor stopped buying and panic sell without looking at the full picture. Equally dangerous is to be recklessly bullish and over leverage in a range where a short-term flush could wipe you out before the real move happens. The smart play is to know your levels, manage your risk, stay informed, and not let Twitter sentiment make your financial decisions for you. If Bitcoin holds above 78,000 this week and we see any positive catalyst, whether it is regulatory news, ETF inflow data, or Saylor announcing a new purchase, the move toward 80,000 and beyond could happen faster than most people are prepared for. The FOMO when 80K breaks is going to be real. And the people who were paying attention, the people watching videos like this one, are going to be in a much better position than the people who panicked out at 77,000 chasing a ghost. On the flip side, if we start seeing daily closes below 77,500 with increasing volume, if ETF flows turn negative again, if the macro picture deteriorates because of Fed uncertainty or geopolitical escalation, then respecting that data and protecting your capital is not weakness. It is intelligence. This market will always give you another opportunity, but only if you still have capital to deploy when that opportunity comes. I want to hear from you right now in the comments. I genuinely want to know. Do you think Saylor stopping is bullish or bearish? Are you buying here, holding, or waiting for a lower entry? Are you nervous about May, or are you actually excited? Drop it below, because the comment section on videos like this actually matters. The collective intelligence of people paying close attention is sometimes more valuable than any single analyst's opinion. And if you are new here and this video gave you actual value, actual real data that you couldn't find scattered across 10 other videos, then subscribing takes 2 seconds, and it means you don't miss the next update when this situation develops further, because this is moving fast. Every day there is a new piece of data. Every day the picture shifts slightly. And being first to understand what that shift means is where the real edge lives in this market. Here is my final thought, and I want you to sit with this one. Bitcoin has survived things that would have killed any other asset. The 2020 March crash, where it dropped 50% in 2 days. The 2022 Luna collapse that took out billions in a week. The FTX scandal that shook institutional confidence globally. Every single time someone declared it dead. Every single time the obituaries were written. And every single time it came back stronger, higher, and with more institutional legitimacy than before. One quiet week from Michael Saylor is not going to end this story. Not even close. The Bitcoin story is not over. If anything, right now, at this exact moment of confusion and uncertainty, it might be entering the most interesting chapter it has ever had. Stay sharp, know your levels, manage your risk, and I will see you in the next one.